We're live. Let's get ready to go. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kurt Chisholm. I'll be your host. And today, I guess I'm running solo because I don't know where the heck Doug is. So we might do an abbreviated one because I don't like talking to myself, but I wanted to at least put something out here. We're the week before the July 4th weekend, so things are a little light in the markets. And apparently with people, Doug must be out hunting or maybe a bear got him. I don't know. But either way, I'm not sure where he is. So if he comes on midway, we'll dump him in. If not, we'll hopefully has a good excuse next week. Anyway, as we kind of dive right in, so today is the 26th of June, and it's it's both interest. Markets are both interesting, and it's a bit of a snooze. The summertime things get a little light. The markets, the volume gets a little lighter, interest gets a little lighter. People start going on vacation. And while there's still stuff going on, obviously there's a lot less interest in markets, and I think rightfully so. I think the markets have shown us this year that we're getting a lot of volatility, but it's not really going a whole lot of places. I'm going to share with you what the market's done this week, some news and updates, and just kind of general thoughts on the market overall. So let's kind of dive right in. I'm going to share what the market's done this past week. So this is a visual. Size is based on market cap. So the bigger the box, the bigger the market cap. And if you look at this is the S&P 500. So each box represents a company. The bigger the box, the bigger the company. So there's some small boxes and some big boxes. But if you look here overall, what you're seeing is the largest boxes are basically the Mag 7. You got Apple, Microsoft, Nvidia. You got Google, you got Amazon, you got Tesla, Meta. Now you got some semiconductors, obviously, that are doing better than the rest of the market, and it's kind of an interesting dynamic here. You got Micron, you got Broadcom, you got AMD, Intel. They're winning the show right now in the technology group. But if you look at some companies, you look at Palantir, you got Oracle not doing very well this past week, down double digits. You got a lot of companies actually down double digits, and I think it's probably not a bad idea that some wind comes out of the sails of technology. Just going too far, too fast, unsupported by the kind of growth that it would warrant for that kind of growth in the last 6 months. But this snoozer that's actually taken off in this past week is healthcare. Healthcare has really done well in the last week. If you look at this, just kind of share what's going on this year. We talked about last week where the markets are going, where they've been. So for the most part this year up to this point, technology has led the way almost exclusively. So the returns you've seen in the index have almost exclusively come from technology. Now, other sectors have been fine, but they're basically flat. They haven't really gone. They bounced around a lot, but they really haven't gone anywhere. They had some bump at the beginning of the year, but since then they haven't really done anything. Now, the reason I'm showing this chart is to give you a flavor of some things that you want to watch out for. Some things we're watching out for is what we call like a natural rotation. And a natural rotation is, technology's led the way, and now technology's taken a back seat and not leading the way. I mean, the index today is more or less flat. Nasdaq's down, Russell's down, S&P is up like 88 basis points. It's basically flat. So, if you look at that, what you're really seeing is technology. We need technology in order to have the index progress. But the whole rest of the market is filling the gap because of this huge sell-off in technology. At the same time, you're getting, a run up in a lot of other areas, like in healthcare is a big one, utilities, in areas like that. And I can't see these, but some of these are too small for me to see. But regardless, what you're seeing is a rotation. Financials are definitely doing okay in some areas, not all areas. So what you're seeing is a rotation. Now, rotation is actually healthy. Now, if you want to know, and this is the reason I'm going over this today, is if you want to understand the direction of the market, you need to understand the market dynamics of how it works. Now, frequently in the last 15 years, technology has led the way exclusively. were Mag 7 or bust, or before that it was, I forget all the names they called it, FANG, FANG, then the FANG M, and then, all these acronyms that describe the stocks that are leading the way. It was typically a handful of stocks that are doing all the work. Now, if they're doing all the work, does that mean the rest of the market's doing the work? Sometimes, but not necessarily. So for the most part, in the last few months, it's been exclusively technology. The rest of the market has gone nowhere. But if you look at earlier in the year, pretty much from September until quote unquote the end of the war, the end of March, technology went nowhere. It went sideways basically for 6 months. And then, like a rocket ship, after the war, quote unquote, ended for the first time, the technology shut up a lot, and that's brought the markets up. Prior to that, the markets were down, but now the markets are up for the year, almost exclusively because of technology. So, but if you look at this 6 months starting September till March, when the war started, technology was doing nothing, but the markets did well. They did really well. Why? Well, they did well in large part because of what we call a rotation. Now, there's 11 sectors in the S&P 500, and some would argue 10 because some people don't include real estate, but real estate is still a sector. So there's 11 sectors in the S&P 500, and one of them is technology, and technology has in large part led the way. Now, if you look at a normal rotation cycle, what happens is things rotate in and they rotate out of favor. And let me just show you a quick chart. So if we look here, this is a rotation, and these different sectors, you've got the upper left, which is improving. You've got the upper right, which is leading. You got the lower right, which is weakening, and the lower left is lagging. So think of it as a circle. So things tend to go clockwise. So they go from lagging to improving to leading to weakening to lagging. And that's a cycle. That's what happens, right? And what we're seeing here in this cycle is a healthy cycle. Now, if you looked at a few weeks ago, technology was leading and the rest were pretty much lagging, or I don't even know, improving, but they're lagging. And now that you're seeing a rotation, all the other sectors are picking up the slack that technology's lacking. So here's what happens. Let me explain under the surface what's happening. So when people talk about rotation in the markets, it's actually healthy, because what it means is the leading sectors is no longer leading. It means everyone else is taking up the slack. That means that money is rotating out of tech and into these other areas, which is why they're going up, because money's rotating into them. That's healthy. That's the way the market should work. There should be natural rotations. Now, normally they rotate based on economic cycles, meaning in certain cycles, technology does well, certain cycles it does not do well. Same thing with healthcare, staples, utilities, and whatnot. When those areas rotate in, that money has to flow out of something and in there, which means it's flowing out of tech and into these other areas. So there's a certain amount of money and it has to go somewhere. And a lot of portfolios are done in such a way that they require you to invest in 100% equity. So like a mutual fund, large cap growth mutual fund has to put money into large cap growth stocks. It can't put it into cash, can't put it into bonds, can't put it in small cap, it has to go into large cap. So what tends to happen is those managers look at it and say, well, our technologies, it's too expensive. Let's put money into some cheaper areas like utilities and staples and healthcare, communications, financials, stuff like that. So what happens is they sell their tech or some of their tech and they put it in these other areas, which causes these other areas to rise and tech to fall. And that's how markets operate on a normal basis. Now, the markets have stopped operating on a normal basis in the last 20 years. We're used to rotate based on economic cycles. Now it just rotates based on money flows, which is not healthy, but you gotta play the game that's being played. You can't play a game that you want to play. You have to play the game that's actually in front of you. So the way that it works is these areas. So you want to be in these areas. This is a time you want to be in an equal weight fund, because with this rotation, the markets aren't moving forward. This healthy rotation's fine. These other areas are doing fine, but the S&P isn't, in large part because of tech. And this is what was happening, in the Q4 of last year and Q1 of this year. So just because these areas are doing well, it doesn't mean the index is going to do well. So just a note. So these are things you need to keep in mind. So rather than being in the S&P 500 market cap weighted index, you should be in the equal weight. Now the difference is in a market cap weighted index, stocks like the Mag 7, Nvidia, Google, Amazon, Tesla, Meta, Apple, Microsoft, some of the biggest companies out there, in a normal, like the SPY, which is a market cap weighted index, which is how the S&P 500 is weighted, so it mirrors that. These stocks are going to these stocks perform well. It does the most damage to the index, up or down. So they're not doing well now. It means that the index is getting weighted down by these stocks because they make up about, technology is about 30% of the index. So if 30% of the index is going down, it means the other parts of the index have to do really well to offset that, right? And you see healthcare is pulling its weight. It's not big enough, but it's pulling its weight. So, and some of these other areas are too. But that's why the index is flat today, because you've got these areas offsetting each other. So that's how the index works. Now, if you have an equal weight index, it means all these little boxes are equal size. So Nvidia, Microsoft, Apple, Google, Amazon, Tesla, Meta, if they go up 20% in a day, the index doesn't budge because it's only 1/500th of the index compared to 30% of the index. So that's why there's a difference, and that's why people like the equal weighted index, because it shows a more healthy market. Now, I like the index not because I invest in it, because I use it for an indicator. It shows me, is this market healthy or is it not healthy? If it's going up, it means the market's healthy. If it's going down, or it's not keeping track with the index, it means the index isn't healthy, right? Because it's being pulled by a handful of stocks. That's one indicator I look at, right? It's not the only indicator. There's like tons of indicators, but it's an indicator I look at because I want to see, is there a divergence from the S&P equal weight and the S&P market cap weight? So just something to keep in mind when you're looking at markets. Now, let me go back to this rotation because I want to finish this up before we move on. All right, so looking at the rotation chart here. Now's the time, and this doesn't mean it's going to always do this, but now's the time to look at diversifying into other areas or other sectors because they will tend to do well. I know healthcare's and certainly biotech has done well in the last week. And that's one of the sectors we've talked about a few months ago, that in a rotating market, you want to see staples, healthcare, utilities doing well. Utilities is going to largely depend on the interest rates, which we'll go over the news in a few minutes. But I would tend to be a little cautious around interest rate sensitive stocks right now, like real estate or utilities, in large part because we just don't know the direction. Now, the yields have been dropping, which is good. That's healthy. But of course, that's because the war is over for the 20th time. I don't know that the war is going to be over for years, but at the moment, let's say it's going in a direction that is somewhat positive. At least if you're thinking the war should be over, then it's positive. The rest of it, I'm not going to speak to because that gets into politics and public persuasion, manipulation, all that. So anyway, so when we look at this, we see energy. I would also stay clear of energy, just because if the war is ending, oil prices go down, which they are, which impacts the energy sector. So energy had a good run up. I would stay away from it for the moment. You want to look at things like industrials, which have been doing fine. Financials, I'd be a little cautious of financials, just because financials in large part are driven by the yield spread. So the spread between where banks borrow and where they lend. And the narrower that spread gets, the less well financials do. So I would stay clear of financials, just because the spread has been narrowing. Not a ton, but the direction is narrowing and getting to the point where it maybe even inverts, which means banks are making money, which means that financials, some financials would be fine, but I'd probably stay clear of the lending banks. You might be fine with things like, MasterCard or Visa, because people are still going to be spending money, which they are. But consumers discretionary certainly has not been the best performer. But staples, utilities, healthcare, materials, industrials, things to keep an eye on, I would say. And some of them have been doing very well, so I would just kind of keep an eye on those areas. So moving forward, I'd focus on that. Some other areas that you want to keep an eye out for are, I would start paying attention to. So first of all, I want to, well, before we get to that, so oil's down quite a bit. Oil's down below 70, which is great. It started the war right around 65, and right now we're at 69.5. So good progress. But if you look at an ETF, what's the ETF? USO. USO, I'm going to take a picture of this, share it here. So if you look at USO, USO is the ETF version of oil. And I'm going to share it here. So if you look at this, what you will see here is that right before the war, we're trading at somewhere around 80 bucks. And now we're at 105. One as high as 150. But somebody seems to be at the door. But anyway, so we seem to have yeah, somebody's at the door. I don't know if they're trying to sell me something, but anyway, we seem to have a huge discrepancy, because if you look at this and then you compare it to like oil prices, I'm going to take a chart of the oil prices and show you the difference here, so you can see exactly why we're a little puzzled here. So if I look at this and then you compare it to this one, okay, this one is the actual price of oil. You'll see it's actually very close to where it started. But that's not the case on the other one, right? On the other one, on the USO, it is huge discrepancy. You're talking about $25 discrepancy compared to like, a $4 discrepancy. So what's going on there? Well, a lot of it has to do with futures prices. I'll just say that. And this is one of the reasons why investing in commodity ETFs is a challenge. In large part is because when they invest in futures, because they're not buying, I don't believe this buys barrels of oil and sticks them in a trust in a vault somewhere. I don't think they do that. I have to look it up, but I'm pretty sure they invest in futures, which is what a lot of commodities do. Gold is different, silver is different. I'm not sure about platinum, but most of the other ones invest in the futures price. Which, if that's the case, there's a huge discrepancy because of the futures. Because at the end of the contract, they're basically contracts based on time. So they expire. When they expire, they roll over to the next quarter. Well, in that roll, you tend to get a loss, and also there's a cost to it. There's a lot of things that happen. I generally try to stay away from those unless there's a very, very strong direction, like we saw with gold last year. Now, gold is not set up that way, but if it was, I still probably would have done it, just because the direction was so strong. Kind of like with this, the direction's so strong, even though it's futures, you could have made a lot of money really quickly because of that direction. Now, people are starting to realize that the war is maybe it's over, maybe it's not, but at least they're trying to open the Strait of Hormuz and they're trying to get the oil flowing, because a lot of emerging markets are struggling. So that's just something I just wanted to share, just because it's notable, and a lot of people are asking me questions about the difference between oil and that, and why is there such a big difference. Now, that being said, I do want to point out the fact that you are that's weird. What you are seeing now, and I want to turn your attention to gold and silver. And the reason I want to point your attention to them is this. I'm going to take some pictures and share. Is that we've been talking about this in the show even last year. So last year, we were very hot on precious metals, and hopefully you were following the show. You might have thanked us a little bit for that. But if you followed us last year, we said precious metals were an area you want to pay attention to, and they did very well. Here, I'm going to show the chart. So this is gold, okay? This is the gold price in the last 12 months. So it obviously did very well in September. till November, and then it did really well in January, and then you had a huge sell-off, and then it's just progressively gotten worse. Now, the thing to keep in mind here is that prior to this, gold was going up about 23% a year in general. It was a good clip. I was actually pretty happy. No one was paying attention to it. It was doing very well. You could have it was still very cheap compared to an expensive market. It was like the only area that was cheap. And we had low oil prices, which if you look at mining stocks were up like 100 to 200% depending on what you were in last year. It was crazy. Um, the reason mining stocks did well is because you had low oil prices. So mining stocks are easy. It's energy in, metals out, right? Cost of putting energy in equals more metals out. So if you have cheap energy and expensive, commodity out, you've got a big spread. You make lots of money. That's why those were doing well, and it's because no one was paying attention to them. People just ignored them, right? Kind of like energy stocks. People ignored them until they did well. But then you look at September, things did really well. In January, things did really well, and now you're seeing a sell-off. Now, the reason, and we said something early in the year that you want to be cautious about this because things were getting a little too hot. But if you look at this, what you recognize is there's a lot of energy went into this. This is not normal. If you pull this back and you look at like a 20-year chart, which I'm going to share here. So here's a 20-year chart. Oh, I'm looking at the wrong one. So if you look at the kind of a 20-year chart here for gold, what you're going to notice is this. You're going to notice that it goes through periods where it's really hot, and you're going to notice it goes through periods where it's not hot. I'm going to share it here. So here we go. So here's gold for the last 20 years. Okay, it went from a low of below $800 up to a high of 55.50 it looks like. So that's a huge run up in the last 20 years. But you'll notice there are times where it runs up, and this was a bubble. This is actually a bubble where it ran up from like 2009 up to 2011, and then it broke down and then went sideways for a while, and then really broke down for a few years, and then it started to go up. But there's a lot of these periods where it's more or less flat, and then it runs up 2019 to 2020, and then we hit COVID, and then it went sideways. And then in 24, started to take off again. So you see these periods that go sideways, it goes up, sideways, up. That's normal for gold. Gold does not go up at the rate of money printing every single year, which is what those newsletters will tell you, is that, oh, well, they're printing money, so gold's going to go up. Yeah, eventually. So if you see this run up, this is actually quite a bit in comparison. This is similar to this period right here, that huge run up, where it takes a long time to burn it off. And in this case, it took 2 years to burn off. Then actually went down. But I don't think it's going to go down that much for many reasons. But I do think that if you look at where gold is in comparison, right? And earlier here, this red line is a 200-day moving average, which means it's the average price over 200 days. So it's well above that. It started to go below it. You got to be cautious. I don't think we're going to hit that point here. This is way above the 200-day moving average. I think it's a little too far above, and this is where I was starting to get a little concerned. But this period, it's well below that. So, but I do think that we are in a period where things are weak for gold, and I think that's okay. And for those of you who have gold in your portfolio, just ignore it. It's not there for day-to-day speculation. It's there in case things go horribly wrong in the global economy. And I also do think that gold is going to be one of those things that if we do have a reset in the monetary system, which is inevitable, I'm not saying it's going to happen tomorrow, but when it happens, it's inevitable. It's going to happen because it has to happen. That's the conclusion. Nobody can predict the future, but if you look at the possible outcomes of the global economy, the only reasonable scenario for people to all get together is to incorporate gold in one way, shape, or form. So I don't know what that looks like. Nobody does, but let's just say I have gold in my own portfolio because I'm looking at it and saying, just in case that something happens overnight and we miss it, I don't want gold to go up, $2,000 in overnight because the government announced something. So we have gold in there always, but the size will vary because, right now it's a size that I say, well, things are going down. I'm just going to eat it because we made money in gold going up. We're okay sitting on it at a smaller position. But I would say that I am considering adding here. I'm not saying you should go out and buy gold. I'm just saying now would be a time where people are a little disgusted with it. I might add a small position. Um, I do think that we might see weakening until the end of the year with gold, which would actually be a good time to buy because you'll see a lot of tax loss selling. A lot of people are going to sell their gold positions when they bought it up here and they went down, and that's actually a good thing because that shows that people are just blown out and they just want out at any cost and they don't care. So I would watch out for that towards the end of the year. That's 6 months from now, but I would watch out for that. I would also, this is the chart for silver, very similar. And by the way, this purple line, where is it? I guess the blue line here is actually the price for the start of the year. So the 43.77 on gold, that was the starting price in January. And if you look at now, it's 40.77. If you look at silver's well below that. It started the year about 71 and change. Right now it's at 59. I think it went down to like 55 at some point. There is a lot of support around right below where it is. So I think silver is going to be a little interesting. I'm not sure if it'll go lower, but chart wise, I would say going down to $50 I'd be surprised if it goes below 50. Let's just say that. So things this is why we look at charts on the show, because things tend to happen in a repeatable way. It's not 100%, but if you had to make a bet, if you're in a casino and you're betting on probabilities, it would be a good bet to consider these things. And if you're wrong, you can always get out and you're not going to lose a ton of money. But I would definitely be looking at taking positions at this point because there are some points where it gets cheap. I don't think we're insanely cheap yet. I don't think we're there. I'm not sure if we will be, but I would just start considering that for portfolios. If you're looking at buying gold or mining stocks, now would be a good time to consider it. I wouldn't go all in, but I'd maybe take some small positions, take some starter positions, take a look at it and see if it's something you want to add to. But that's just something I would consider at this point. So I am getting a little bit excited about precious metals. One area that I know I've gotten a ton of questions on, and we've seen a very interesting week here. Is if you look at crypto this week, you look at Bitcoin. I think right now it's right around 60,000, and I think it started the week about 64,000. That's a big sell-off. Ethereum started about 1,700, and right now it's around 1,580. If you look at another indicator of this is if you look at strategy. I have to print this up just because it's worth noting. Okay, so if you look at strategy, which if you don't know strategy, don't bother. But strategy is basically a company. It's a public company that owns Bitcoin as a Bitcoin treasury. So as the price of Bitcoin goes up, the stock goes up. As the price of Bitcoin goes down, stock price goes down. It's very correlated. I scratch my head as to why this is even allowed to exist, but those of you Bitcoiners understand it, and I'm not going to debate it. I do think that there's some tomfoolery going on with strategy. I don't think it's criminal, to be frank, but I think the structure is not something I feel comfortable with. And I don't want to get into strategy, but it's one of those things where I've heard the explanation many times as to why they're doing it and why it works. I can't understand it. And I get into the Warren Buffett camp on this. If you don't understand something, just move on. It doesn't make me comfortable. There's something that makes me feel really uneasy. I'm not saying there's anything wrong going on. I'm not claiming anything. The guy seems really smart, and I've heard a lot of my smart friends explain it, and I scratch my head. I say, this doesn't smell real. There's something off, and I can't put my finger on it. I can't put a name to it. I don't want to call it fraud. I don't want to call it a Ponzi scheme, but it's similar. So it's probably not, but there's enough similarities that it puts my antenna up and say there's something going on here and let's pay attention, which is why I don't touch the stock. It just seems there's something that seems off, and I can't claim to know anything. It's one of those feelings you get. You do something long enough. We do a lot with risk management, with alternative investments and strategies, and I've seen a lot of stuff over the years. And sometimes you don't know something to be true, but it just smells off, and you just have to go with that gut because um, it ends up being right more often than not. And there's plenty of investments out there. You don't need to stretch it and make one work if it smells off. So, you know, there have been a few frauds in the crypto space over the years, and I've had clients ask me about things, and I just say it doesn't smell right, and it turns out to be a bad idea for them to do it because you may not know for sure, but it just seems like it's not a good idea. I'll give you an example. So we invested in this company. Let's say my partner and I personally took a flyer many years ago. It was like 2016 or 17. It was a company, I think it was called Hive or something. Anyway, it was basically like you invest in these contracts and in crypto mining, and they'll mine crypto. You put in $100, whatever, and it would mine out crypto, right? And I was like, okay, this is a good idea. But then what happens is the contracts default when it's not profitable to mine crypto. So what happens when the crypto goes down? Your contracts are null and void. So you lose your $100. You still get the crypto you mine, but that's it. I was like, okay, I get why you wouldn't do this. And, it's $100. It was a lesson. I don't care. I mean, it's why I did it. That's why I didn't put in more, because I wanted to figure out where the holes were. And I realized, I'm like, okay, this is not a good model, right? Because, you lose your $100. It's good for them, not for me. However, now that crypto is actually worth more than 100, but still, because I never sold it. But it's not. The point is sometimes you things seem a little off, and so you just try it out. And that was an example of that. But if you look at the stock price here, what's happened is you're getting a huge amount of selling pressure, and a lot of people are trying to break open the vault. So this is a Bitcoin treasury, right? So they basically own Bitcoin. They've done a lot of creative finance as a way to expand their Bitcoin offerings. And Michael Saylor, rightfully so, has said, well, this is our model. He's explained it to everybody and said, here's how we work. And he's been very transparent about it. Wall Street sees that and says, excellent, like the Montgomery Burns, version, where he's like, all right, I'm going to go and I'm going to try to break the bank. And so there's many ways they can do that. They can drive down the price of Bitcoin. They can drive down the price of the stock. He's got this stock, plus he's got a few other public offerings that offer interest. I'll tell you, when Wall Street has their targets on somebody, I do not want to be in that ballpark, because they're going to keep pushing until they break the bank. And by break the bank, I mean cause Saylor to sell Bitcoin. And he said, well, I'm going to sell like a coin just to say I did, and but that opens the door and says, well, future offerings, he can do it and not have to worry about it because he's already done it. So it lessens the blow if he has to sell it. I think Wall Street trying to force him to sell it. There's a huge sell-off. I mean, if you look at the stock price, it was a high of, in the last year, it was a high of $412, and now it's at 84. What's that, an 80 some odd percent drop? Just saying, not saying much, but an 80% drop is not great. And I certainly would not want to be sitting on this stock at the moment. I would not want to touch it, but I am watching it just out of curiosity, because to me it's just interesting to watch how Wall Street treats wounded animals. It totally goes after wounded animals, and if anything, it wounds them and then makes it worse. It's a common pastime of Wall Street. That's how they make money. So they break the bank, and it causes them to sell coins, which drives down the price of Bitcoin even more, which causes them to sell more coins. And it's this negative reinforcement loop, and it just drives down the price of crypto, through the floor. At some point, that's going to be great. Now, if personally, I am a fan of crypto. I'm having an issue here with my video. I'm a fan of crypto, and not necessarily at this price. I think we're at a liquidation phase of crypto, which happens once every 4 years or so. So it goes well, goes up, does really well, and then there's a distribution phase where people start to sell off, and it does really poorly. It usually goes down about 70%, somewhere thereabouts, and then that's usually a good time to start looking to buy. I suspect we will probably see a point this year, assuming that crypto doesn't take off and Trump doesn't say, "Oh yeah, great, we're doing X and we're gonna, put all the currency on Bitcoin or whatever they say they're going to do." There's going to be some announcement at some point from Trump that they're integrating crypto, not Bitcoin necessarily, but crypto into the financial system, and that should shoot up a few of these quite a bit. I don't think we're there yet. I think it has to get a lot lower, but I also think that if this keeps going until the end of the year, which I suspect it might, that could be a really interesting time to pick up some crypto. If you're into this, if you're not, don't speculate. But if you understand it, if I was buying Bitcoin, which I do occasionally, and Ethereum or my two that I like, but there's other ones that people like too. I just don't know them, so I don't invest in things I don't know. But if you look at these, I would look at year-end tax loss selling. It's a great time. People are probably going to be disgusted with it over the next 6 months, which is a good thing. They start to just close out their positions saying, "Oh, I've had enough. I can't do this anymore." And they're out. And that's great. And that's the time you want to pick it up, is when everyone's disgusted by it, nobody wants to touch it. It's toxic. That's the time you want to do it. And so personally, I love those times. Those are the times that I wait for. I wait for times where things are bottomed out and are a good buy. That's when I want to invest. So I'm going to be looking for that. So as we kind of wrap it up for the week, there are a few areas in the markets to keep note of. Japan is an area that I like. I've liked it for a long time. There's so much value in Japan. I think it's a good long-term hold for the moment. There's so much value that can be unlocked there. Korea is actually, South Korea has shot up a lot this year, and I don't follow it much. It's mainly due to a handful of companies that they have that are doing very well. So the Kospi has done well. It's not doing well today, but in general it has. But other than that, the things I would pay attention to going forward are the rotation. I'd pay attention to international markets. I would stay away from emerging markets. I know they've done well for the most part, but I would be a little cautious about emerging markets right now, just because oil prices, and I think we've got another 6 weeks or so. If the Strait of Hormuz is open, we get another 6 weeks from that point when things are still going to struggle. I think earnings season this quarter is going to be a struggle for a lot of people. And I think that's a great opportunity if we start to see a lot of sell-offs. It's a great opportunity for investors to buy good stocks at good prices. I'm going to wrap it up here with a little bit news in the week, just kind of a summary. So inflation, the PCE index, which is what the Fed really likes, the preferred inflation index, rose 4.1%. The annual rate in May, which is the highest in the last 3 years. I would just be a little cautious about making assumptions about inflation. Because of the war, inflation's kind of all messed up, and it's messed up the economy. It's messed up earnings, messed up a lot of things. I'm not sure if that's going to be permanent or not. I think that's when people get a little squirrely about inflation and interest rates. I tend to be a little more cautious about making claims, because at this point, it's really not it's really not indicative of where things are going. It is sort of, but it's it's like having a puzzle all done except for the last piece, and somebody comes in and turns over the card table and it goes everywhere. It's basically what the war has done. You can't make a prediction about a lot of things right now, because we don't know the outcome of the war. The war could last another 20 years for all we know. We don't know, right? We're listening to Trump, and hopefully nobody's paying full attention to him. But directionally, it sounds like things are going in the right direction. But still, there's a lot to be desired in that. And oil prices are down, but for how long? I don't know. But these are a lot of question marks in my mind. But things are going in a better direction. War's not over, but people seem to not care. Market-wise, people seem to not care. But inflation's a little bit higher, so just something to keep an eye on. Um, you know, there's the Fed funds rate is unchanged, but we have our new chair, Kevin Warsh, who's generally, when a new Fed chair comes in, they're trying to set the stage. They're trying to mark their territory. They're trying to be tough. And he came in. He's trying to be tough. He's trying to, he's leaning hawkish, which caused a little bit of a sell-off in stocks and a rise in yields. But realistically, I don't think he's going to raise rates. I think in order to do that, you would need to see a noticeable reason to raise rates, and right now we just don't see that. We see a slight reason, which isn't good enough, because the war ends, oil prices drop, which, by the way, if the war ended today and everyone said, hey, we're fine, we're all on good terms, everything's going to be dandy, oil prices are going to go through the floor because we have a glut. Because we've made so much oil over the last few months. We've started a bunch of rigs and we've locked in prices at 100 and change. So what's happened with oil prices, there's going to be a ton of oil pulled out of the ground over the next year or so, and that's going to cause a glut, which is going to drive oil prices way down. So it's not happened yet, but that is what will happen, and just be aware of it. And we might be 6-12 months from now, but it will happen. It's what always happens when you have these events, right? It causes a shock because we don't have enough. So people just go out of their way to make enough, and then they overdo it, and then the shock ends, and then now we've got too much, and we've got a glut. That's normal. That's something to expect. So anyway, so Kevin Warsh is setting the stage for being tough. We don't have enough data to say what he's going to do yet, but that's what he's saying, and I expect he would have done that. A lot of people are expecting one rate hike this year. I don't. I certainly don't think it's going to happen before the election, and even after, things would have to get a lot worse, and I'm not sure if they will. So, tech stocks obviously haven't done well. We shared that chart. I do think that people are starting to get a little concerned about OpenAI's IPO. You got Anthropic's IPO, but I think a lot of people are shedding a lot of concern on OpenAI in general. I think their business model is flawed, very questionable, and we'll see. But I personally, I wouldn't touch either of these LLM companies. I don't think there's a moat. I don't think there's anything standing in anyone's way, myself included, from creating my own version of that. So I just don't think it's a viable economic concept. It's like being a tobacco farmer. There's nothing stopping from anybody else from being a tobacco farmer. So there's no moat. Anyone could do it. It's going to drive down the costs. They're probably not going to make any money for a long period of time. And why invest in a loser when there's really no good way that they can become profitable outside of selling all your data and to advertisers? And I have no interest in giving them that kind of data. So, and that'll eventually happen, I think. And that's probably shortly down the road. But who wants to put all their data in another social media company so they know everything about you and sell advertising on you? I don't. Anyway, so technology stocks are taking a back seat. I don't have the dates yet as to when OpenAI and Anthropic are going IPO, but they certainly it's coming soon because they filed. We talked about the rotation, oil price ease. Yep. The global central banks are holding steady on their rates. The rates have been going higher, but so far, this Bank of England, Swiss Bank are holding steady. And then consumer sentiments are near historic lows. So, University of Michigan consumer sentiment, I think, is about 48.9. It's near historic lows. I'll try to get a chart next week. So basically, that's the show for this week. That's the wrap up. Things are a little bit light. I expect next week things will be light as well with the holiday coming up. Not sure when we're going to do it, if we do it Friday or Monday, the next show. But either way, the summer tends to be light, so we'll try to come up with some fun topics for everyone, because the news will be light too. People are on the beach and they're really not too focused. So we'll probably try to come up with some interesting educational topics throughout the next few weeks. So anyway, so that's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app you're choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead. And remember, no one will care about your money like you do. So invest in your life.